Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. Today, I'm going to take a rather comprehensive look at the company Autoliv, the world's largest automotive safety company. And we're going to look at it from a valuation perspective, as well as an income perspective, as well as a total return perspective. So let's go ahead and get into the fast graph on Autoliv. First of all, as you can see, the company is quasi-cyclical, where earnings growth rises for periods of times, drops for periods of times. It was very flat going through 2016. It started to increase nicely, and then we came into COVID and the earnings were down. But then since COVID, really since the beginning of 2021, the stock has really put together an impressive rate of growth of over 21% a year. Now, when you put weekly closing stock price on the graph, you clearly see that fundamentals drive stock prices. I think that's one of the most important lessons I try to get people subscribed to, and that is the fact that it's really the business behind the stock that creates wealth and generates wealth. And this company has had healthy profits year after year, although it hasn't had a great deal of profit growth, but is expected to grow pretty strongly going forward. Analysts are forecasting growth of over 13% for the next 2 or 3 years, about 4.5% this year, which is, I think, partially explains why our valuation is low, but then increasing by 18% in 26 and another 12% or so in 2027. And there's a relatively large number of analysts following the stock. Estimates have been dropping recently, which is another reason why I think you're seeing this weakness in stock price currently, but I consider this an opportunity. The stock has a PE, a blended PE of under 13. It has an earnings yield as a result of over 8%. I like a minimum of 6.5%. It also has a very strong dividend yield of 3.23%. And it does have a history over the last several years, excluding COVID, of increasing that dividend. So I think there's an opportunity here for growth as well as an opportunity for rising income and a pretty generous level of income looking at the stock market now. Now, the thesis for growth for Autoliv is actually pretty well defined. And first of all, there are industry tailwinds and market positions. As the world's largest automotive safety supplier, it's well positioned to benefit from a 1 to 3% projected annual increase in global vehicle production, providing a stable foundation for revenue growth. And as, again, the leader in automotive systems, it stands to gain from increasing regulatory and consumer focus on vehicle safety, which is driving higher safety content per vehicle, especially in emerging markets like China. Now, the company has demonstrated resilience in both revenue and net income, even amid subdued industry growth in 2024, and the company continues to enhance share fair value through share repurchase programs and dividend increases. Now, I want to make a point about that. I like to see a company buying stock back when their stock is cheap. When I'd be interested in investing in the stock, that's when I think the company should be interested in buying their stock as well. Now, the company does have a very strong balance sheet. It has less than 37% debt to capital. The company has strong operating cash flows. So let's go into fiscal fitness here. Let's look a little deeper into the company's financials. And I like to do this with companies I'm looking at. So what I'm going to do here is I'm going to just focus on the last 5 years. And the first thing I want to look at is return on invested capital. And as you can see, return on invested capital has been steadily increasing for the last 5 years. And it's over 16% in 2024 and expected to continue to increase. Return on equity has also been substantially increasing year after year. And it's approaching 30%, 26, 27% return on equity recently. And returns on assets are also strong at over 30% for the current year. Now, the company has also been producing steady margins. Their gross margin has held pretty steady at around 16 to 18, we'll call it. Their operating margin has kind of increased from around 6 in 2020 to over 9. That's about an 11% compounded annual growth rate. And its net margin is increasing at over 25% a year. So I think that's a very strong indicator that the company is doing well. Now, debt to equity has been actually dropping a little bit, began to rise a little in 23 and 2024. Net income has continued to increase over the last 5 years. Sales revenue has increased at about an 8.68% rate over the last few years. Operating cash flow has consistently been greater than net income per share. I consider that a positive. As far as share buybacks, the company did buy some stock back in 2024, and they've been buying a little bit of stock back each year since 2020. And again, the stock is cheap, so I think that's a pretty good indicator. Their operating cash flow growth has been steadily increasing, as well as their free cash flow above the dividend, except for 2022 when it was a little below the dividend. But otherwise, their free cash flow has been greater than the dividend. And we can look at that also from the perspective of the long-term graph here and look at free cash flow has more than covered their dividend generally, but they do have a couple of periods where they don't. That relates to the cyclicality of the company. So now as I'm looking at this company as a future investment, I can learn from the past, but I want to go and always invest in the future. So we're looking at a PE ratio that's basically equal to the growth rate, more or less, just slightly above the growth rate. If I held this stock, and that's actually the growth rate of free cash flow to equity. Let's look at the growth rate of operating earnings, which is over 13%. The PE is 12, so we're looking at a PE ratio that's below the growth rate of the company, which I consider a strong plus. If the company were to trade at a normal 15 multiple, and let's test that, let's look at the historical multiple, and you can see that the company's normal PE and their fair value calculation, orange line valuation, have both been right dead on 15. So I don't consider it a stretch to think the company can rise to a 15 PE. So if we did get the earnings growth as expected, and I've already given you, there's a strong thesis for growth, earnings are expected to grow at over 13% a year. And so you're looking at a stock that could deliver over the next few years a 24+% annualized rate of return if it just operated as analysts expect and returned to what I'd call its normal fair value. Now, because of the cyclicality, the scorecard is a little sketchy, but as I mentioned, there are several indicators, like I went through the fiscal fitness to suggest that the stock looks like it's really in a growth phase here. It's got really strong financials. It's got manageable debt. It's got great liquidity. And it does have, I think, the ability to generate strong returns for those shareholders that are patient and long-term, prudent, fundamental investors in the long run. So this is one that I like at these current levels. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, bringing you my valuation of Autoliv. I think it's an excellent company to look at now. We have a market that's basically extended in valuation, but as I always say, it's a market of stocks, not a stock market. And this is an example of a company that I think can be bought at a very attractive valuation, which means it's a lot safer than investing in the market, has a higher yield than the market, and ability to generate more income than the market if you're defining the market as the S&P 500, and also has the ability to generate some pretty substantial capital gains over the next 3 to 5 years. And again, it's very healthy, it's got a strong balance sheet, and a pretty well-defined thesis for growth. If you liked the video, give me a like, subscribe to our YouTube channel, and also take a look at subscribing to FastGraphs. I can't imagine being an investor in stocks, especially a prudent, long-term, fundamental-oriented investor, which is what FastGraphs is designed to serve, or who FastGraphs is designed to serve. If you own stocks and invest in FastGraphs, I believe you're making a mistake because it's definitely the value investor's best friend. Thanks for watching.